Breaking news hour right here. So RBI has announced a marginal cost of funds methodology for the interest rates on advances. So this is basically a new formula that has been introduced for banks to calculate base rates. We were expecting this announcement. There are details also that have been given. We'll get Lata here and we'll get our guests and we'll get across some kind of reactions for you. But all in all, we were expecting the RBI to announce a new formula. This will change the overall banking framework and the way regulatory systems are measured. So marginal cost of fund methodology has been announced for interest rates on advances. We'll get you more of the details that have been announced, but let's go across to some of our final norms on marginal cost for banks will be effective. Okay, so these norms will basically come into effect from the 1st of April of 2016. So that's an important point to take in. So you now know the methodology. It's basically going to be a marginal cost of fund methodology for interest rates on advances, which will come under effect for the 1st of April on 2016. Do we have a guest with us yet? All right, we'll get you some reactions going. This is an important area to understand. We'll get Lata in to give us the details. Yes, Lata is here with us. So Lata, just break this up, simplify this up for us. We were expecting RBI to announce.
I really wish I could simplify it. It's looking a little complex. See, I'll just tell you what is the base rate. Yeah. This is the banks are expected to add all their costs. Okay. What is their biggest cost? The cost of deposits. So what banks were doing is they would take the average cost of deposits. Correct. There were some deposits raised at 9%, then the rates fell to 8%, some are raised at 8%. They used to add it all, called the average cost, and then you add on costs of running the bank. Yeah. And then you take a return on net worth, which is needed. And then you arrive at a base rate, and then depending on how risky the borrower is, you can add the cost. Okay. Now, what Reserve Bank was saying is that every time they cut rates, banks would say, only my latest deposit is cheap. All my other deposits are expensive, so I am not able to pass it on. Now, the Reserve Bank is asking them to set their new loans according to the newest cost of deposits, so that there is faster transmission of rates. But it doesn't look that simple. What it appears is that banks will have to publish marginal cost lending rate of different maturities every month on a pre-announced date. So it looks like they have to announce several reference rates, and banks may have to specify the interest rate when you take a loan. They will have to specify the reset date on the floating rate loan, and then they will have the option to offer loans with reset dates linked either to the date of the sanctioning of the loan or to the date in which they change their lending rate. Okay. So it looks like a fairly involved set. What is confusing is that they will have to publish MCLRs of different maturities. That is a marginal cost for 1 month, probably for 1 year, for 6 months, for 5 years, 3 years. It appears that way. So it looks like it's really going to be difficult to determine whether there has been transmission or not, because there are so many rates now. Let me just read out some of the other rules. All rupee loans sanctioned and credit limits will have to be renewed on April 1st, 2016, and they will be priced with reference to this marginal cost, which will be an internal benchmark. This marginal cost will be a tenor linked, that is term of the loan linked, term of the deposit linked internal benchmark. Actual lending rates will be determined by adding to this marginal cost a spread, which of course that spread is depends on the credit worthiness of the borrower. If he is riskier, it will be a higher spread. Banks will review and publish this marginal cost of different maturities every month on some date, say 10th or 15th on a pre-announced date. Banks may specify the interest reset dates when they give the loans itself. So when they give a loan, they will tell you on this day we will reset it, and they can reset it depending on the MCLR. The periodicity of the reset will be 1 year. Rates, that is loans, will be reset every year. The MCLR prevailing on the day of the loan is the day the loan is sanctioned will be applicable till the next reset date. Existing loans and credit limits linked to the base rate will continue till repayment or till renewal. As the case may be, existing borrowers will have the option to move to the MCLR, that is the marginal cost regime, as and when it starts. That is, it starts on April 1st, 2016. Okay, that's the story To me, it looks like there are going to be many marginal cost lending reference rates. And in that case, it can be a little confusing, though maybe it will ensure faster transmission, at least in some buckets. Hemendra Hazari, the banking expert, has joined us on the phone line. Hemendra, I've tried to read as much of the press release as possible. To be fair, it's a short press release. First thoughts?
The first thought is that banks have been really resistant to this marginal cost of funding.
Of course.
Because if it were to be implemented, it would have led to a reduction in their spreads in a very rapid period. And since, as it is, their profits are under a great deal of strain from non-performing loans, therefore there has been this great deal of reluctance.
Yeah, but the way it is now announced that you will have several marginal cost reference rates, do you think that this is not going to be a problem for banks? Because obviously only the shorter tenor marginal cost will change. The longer tenors will not change perhaps. Or at least only the tenors that change are going to get reflected. Do you think that with the new several marginal cost reference rates, the bank margins will not be under threat? Okay, why don't you mull over it, Hemendra? I'll get one more guest to speak about it. Anindo Bhaumik of India Ratings Research is also with us. Anindo, what did you make of the rules if you heard them?
Yeah, my first impression was that you're right. I mean, there could be some element of confusion, and I also thought that the MCLRs could be very volatile because this is at the marginal level. But if the periodicity of resets are going to be one year or lower, of course, but assuming that the bank stretch this to the maximum tenor of 1 year, then perhaps a lot of that volatility may not be warranted.
Fair enough.
I think there have been various assessments of impact on NIMs between 10 and 25 basis. So that I think it would be a given, bank to bank.
Okay, I'll just come back to you for a minute. In a minute, Anindo, we have Mr. R.K. Bansal, the man who's wearing the shoes, so he would know where it bites. He's Executive Director at IDBI Bank. Mr. Bansal, I don't know if you heard or read how the new marginal cost is going to be calculated. It appears that the banks are going to publish marginal cost of different maturities every month on some pre-announced date. You can announce it on the 30th, on the 1st, on the 15th, whenever you please. And this MCLR, to it you add the spread and then you get your lending rate. The marginal cost, banks may also specify the interest reset dates on their floating rate loans. So this reset date will have to be annual. You have to reset the loans annually. These seem to be the main elements. What are your first comments?
Basically what it means is that during 1 year, whatever rate we fix in the beginning itself, that will remain. So during this 1 year period, even if 1 year or 6 months, whatever reset you announce, so even if your benchmark lending rate changes, that will not impact the borrower.
Okay.
So it presumes that resources and the lending will be matching the maturities.
Okay. So how many different maturities do you think you will announce from tomorrow or from, April 2016? We will have, 5 reference rates from you? We will have a 6-month rate, 1 year rate, 2 year rate, 3 year rate, 5 year rate, something like that?
It depends. Normally, in any case, if you see the banking perspective, either there is a very short-term lending. Sometimes it is 1 month or 3 months. I mean, the second bucket could be 1 year, and third then could be 3 year and 5 year type.
Sorry, 3 months? 1 minute, sir. 3 months, 1 year?
1 year, 3 year, 5 year. But the issue here would be because reset will be every year. So I presume that we have to do it funding because the banks normally don't get deposits of 3 years or 5 years.
Okay.
So then that risk of ALM, we have interest risk basically we have to take care by repricing, which will be mostly annual.
Okay. Because this is going to be only an annual reset of the loan cost, whereas you will be changing your marginal reference rate practically every month, you think that banks are not going to be in risk of danger to their margins? You think only new loans will be given at the lower rate, but for the older loans, you will have several months to reprice, and therefore the pressure on margins won't be much. Have I understood it right?
Not really. What you are saying is if I give a 1-year loan and because I keep on repricing every month, it will impact my ARM, but it is not like that. What RBI is saying is, if let us say if I have given a 1-year loan, I should fund it from 1-year deposit. So accordingly, when I have declared a 1-year marginal cost of funds, I will lend at that rate plus spread, etc., etc.
Yes.
So during the year, during this 1 year, whatever fresh borrowing I do, my lending will also be at those rates.
Okay, it's not as if all loans need to be reset only once a year. You need to necessarily reset the loans even before that.
It can
as you
be 6 months also.
As you might take a home loan, as you might have taken a home loan from you, it needs to be reset only once a year because there is a clause which says banks may specify interest reset dates on their floating rate loans. The periodicity of the reset shall be 1 year or lower. Now, I assume if you are given 1 year to reset your loans, all banks will prefer to reset only once a year. But even in between, if the marginal reference rate changes, you have to reset my loan only at the time of the reset date, right?
Yeah, because the reset can be 1 year or lower.
Yeah, but don't you think all of you will prefer 1 year?
It depends. In a falling interest rate scenario, yes, but the situation can change later.
Okay. Oh,
so
yes.
As of now, but I would say that most of the banks will prefer 1 year because, see, almost out of fixed deposit, almost 70% or 60% comprises 1 year deposit.
Fair enough. So, okay, then do I understand right that at this point in time, newer loans are likely to get lower interest rate in the current regime when interest rates are falling? Obviously, your marginal rates, your marginal reference rates will be falling, and therefore you can reprice the new loans, but the old loans could take a year to reprice. Is that fair?
Yeah, almost, because in that case, in a falling interest scenario, because my cost of fund will also go down.
Yes.
So naturally, the new loans will carry perhaps lower rate of interest.
And older borrowers will take a little time to get the advantage.
But 1 year is not a very long period, so I presume that they will also get benefit after.
Yeah, for a banker wanting to protect his margins, it will not be when interest rates are falling. I wonder if you would have made this argument if the rates were rising, Mr. Bansal. But that apart, can we say that therefore banks need not worry about too much of margin pressure under the new regime? At least immediately, for the next 6 quarters.
Pressure perhaps will come in the existing loans. The pressure would be there. I feel some pressure would come from the existing borrowers.